Could the market sell-off deepen? Stocks are getting hit with some serious selling pressure on Thursday, with the Dow Jones Industrial Average suffering its largest technical breakdown since January. This is putting a sharp end to the period of low volatility and easy gains that we had seen since May, and really kind of shocking investors back to reality, wondering what lies ahead. The catalyst for the decline seems to be related to the Federal Reserve. We had a slightly more hawkish than expected meeting statement on Wednesday, and then that was followed with some higher than expected wage inflation data on Thursday, suggesting that perhaps the Federal Reserve could be forced to tighten policy sooner than expected, with maybe a first short-term interest rate hike coming in the early part of 2015, whereas before the market was looking for that not to happen until the middle or perhaps later part of 2015. There's a number of moving parts going forward, but it certainly seems like the Fed is going to dominate investors' attention. Now, if you look at valuation measures, the market had been fairly overpriced heading into this correction, so the inevitable question is, how low can we go? One measure is looking at market breadth. This is the number of stocks participating to the upside. Now, we're just starting to come down over overbought territory, and we're quite a ways away from what could be considered an oversold level. If we're going to go back to levels that we saw back in January after the sell-off related to the emerging markets, or perhaps March and April, we're looking at probably another mid-single-digit decline in the Dow from here. However, if we're looking at a 2011 style decline, market breadth measures could get much more compressed than where they are now, which suggests that investors should buckle up. It's going to be a bit of a bumpy ride.